Welcome back. You're still watching Metropol Television's Business AM. Let's move on to the next issue, where Absa Bank has become the first bank to announce cancellation of a dividend payout after it saw its net profit plunge 43.8% year ended December 2020 on costs linked to rising loan defaults. Now, the lender, who posted a 4.2 billion shillings in net profit for the year ending December 2020 from 7.47 billion a year earlier, saw layoffs and closed numbers of employees as it tried to reduce operation costs in a tough year. Now, this comes at a time when the Central Bank of Kenya, CBK, is demanding a high level of capital buffers before clearing banks to pay out billions of shillings to shareholders, with the several banks that have already announced their results, like KCB, Coop Bank and Stanbic Bank, already revising their dividend payouts downwards. While announcing the decision, Absa Chief Financial Officer said, and I quote, "The directors did not recommend a dividend payout because COVID-19 is still here with us and we are expecting a big third wave. Until vaccinations have been done, we are still skeptical to say we are already on recovery." End quote. All right, let's look at exactly how Absa performed year end, so we can talk about that, and you can actually see exactly where the total interest income rose as well. But what is really the talking point is that profit before tax, which recorded at 8 billion. And let's cross over to another analysis of exactly how they've performed all the way from 2018 to 2019, with that 2020 period really being the one in conversation point, because you can actually see they dropped from 7.4 billion in 2019 to 4 billion in 2020. And this is saying is just owing to the effects of the coronavirus pandemic on the economy. Now, Ken, let me begin with you this morning. If you look at the trend that we've seen from tier 1 banks in the country, I mean, most of them, it's either they are revising it downward. We saw what Stanbic did. They're just going to pay 1.5 billion. KCB and Cooperative just promising 1 shilling in dividend pay per share. If this is tier 1 that is already announcing a revising of the dividend payout, what do we expect from tier 3 banks in the economy? Because the question here is capital buffers.
Well, indeed, it's a difficult time for the banking sector, and we did expect to see that because when people lost their jobs, obviously the issue of non-performing loans became a big problem, and banks really had to be able to provide for those levels of non-performing loans. So definitely the capital buffers will be higher. I think tier 3 banks, to your point, they might struggle in terms of getting deposits because there is that sort of move towards risk to safety, if you like, and there is that misplaced notion that sometimes bigger is better. So I think one of the challenges is sometimes the smaller banks might have a challenge in terms of attracting deposit, but on the flip side, they should be able to play more on the relationship side of business. One thing that smaller banks tend to do much better is they have a much better relational experience. So most likely their strategy will move towards relationship banking and really being able to sort of play on that side of the strategy. But I do worry a bit about the regulator in terms of CBK. And I mean, anytime I see CBK wanting to have a say on which banks pay dividends, for me, I feel like they are overstepping their mandate. They are not board members of these banks. These banks actually have risk committees filled with experts in risk who can be able to assess for the bank itself. So I think for the CBK, there's that notion that they might be overstepping their mandate and moving to other things that are not really within their mandate. You know, just the other day we saw CBK launching a real estate project on Gong Road. So when I see these kind of things, I really ask, you know, have they forgotten about monetary policy? Because the CBK exists to look at the conduct of monetary policy. If you look at the stimulus that most countries have had, most countries have done 5 to 6% of GDP. Kenya has only done less than 1%. So I feel in as much as the CBK wants to get involved with so many other things out there, it's starting to forget its core mandate of monetary policy, of monetary stimulus. And I think that's the reason our economy has been struggling. So I think there needs to be a call out for CBK to really return to its core mandate and really to be able to provide leadership in terms of monetary policy.
Yes, Ken, just before I let you go on that, would your critics say, well, these are extraordinary times? Ken, I mean, if you look at the numbers that we've seen in terms of our economy is going to grow this year, there's this optimism that, well, it might jump to 6.2%. The numbers that are saying, well, we might not even see 3% again this year, owing to the third wave of the coronavirus pandemic. Are we in unprecedented times? Is why the CBK really has to come in and be an active member in some of the decisions that these banks are making?
I completely agree. It has to be these extraordinary times.
Yes.
And I think it lends credence to my argument more. This is a time we should have been seen the CBK talking more about monetary stimulus, talking more about the economy, but they chose to sit back. They chose to really be a pedestrian observer. And even worse, they went into other things that are not economic related. You know, when they did the MOU with the Kenya police to do a real estate project, I think for me that was the lowest the CBK has ever been. That was the most underwhelming I've ever seen the CBK at a time when the economy needs thorough leadership. You know, when you look at the US, when people talk about the economy, they think of the Fed Reserve first. When people talk of the UK, they think of the Bank of England first. But, you know, when you come to Kenya, the CBK almost often appears to be a pedestrian. Actually, it's the National Treasury that at least tried to provide some fiscal stimulus, even though those were reversed earlier this year. But at least we saw some attempt there. So I think this is an indictment on central bank, the direction it's going, and they need to reflect on their work on supporting the economy and supporting job creation. These other things, they can actually let it to the people who are more concerned with those.
Pretty much. All right, Sid, let me bring you in on that as well. You see what Ken is saying? Ken is saying, well, yes, we are in unprecedented times, but do you share his sentiment that maybe the CBK should just leave these decisions of dividend payouts to the risk committees in these banks?
Thanks, Simba. Apologies, I think there's a background noise coming from my laptop fan. It seems to be having an issue, so apologies for that. But to go back onto your question, you know, it's you know, there's obviously going to be people who will criticize CBK's moves.
Yes.
But at the same time, it is a move, you know, the CBK has made to ensure we don't get into another situation where a private company goes back to the taxpayers for a bailout. You know, we have seen a similar situation in South Africa, where the regulator in South Africa, the central bank in South Africa, has told banks to make capital preservation a priority by freezing dividend payments and bonuses to top executives. But obviously, on the flip side, there are bank executives who believe that the CBK is overreacting. They cite, you know, stronger liquidity positions on the back of, you know, reduced lending. Because if you look at the CBK annual report during the quarter ended September 2020, liquidity in the banking sector increased, even though it was a marginal increase, from 52.76% in June to around, you know, 53.25%.
Yes.
Which is well above the minimum statutory ratio required for a bank of 20%. And you know, banks have deployed this excess liquidity credit mostly by lending towards the private sector. So some banks do argue that they, you know, there's a lot of cash locked up in the system, yet CBK wants to lump all banks together, and that's where I believe the mistake may be, whether big or small, and not having any consideration of, you know, its accounts. and that may be an overreach by the regulator.
Yes.
But at the same time, profitability for banks has declined by 17.2% to almost resonating to 134.1 billion shillings in profit before tax for the financial year ended June 2020. So when we look at the figures, it does make sense to an extent, to the extent that CBK wants to ensure banks have enough capital reserves to ride out this third wave of the coronavirus. So in that sense, I don't see because when the CBK is trying to understand the capital reserves, and that's part of its mandate to ensure banks maintain certain minimum capital reserves, and it relies on the internal capital adequacy assessment process, among other tools, to assess whether the bank actually has enough capital levels that are adequate and consistent with its business plans, strategies, risk profiles, and the prevailing economic environment of the country. So when COVID-19 has been a major disruption, and that's why maybe CBK would require banks to change their current models and assumptions by making them a bit more conservative than they were before.
Yes. All right, Sid, now just again on that issue as well, I mean, if you look at the liquidity that you're talking about there, I mean, these are levels that we saw back in 2017. Is that not reason enough for the CBK to come on and say, well, for those who want to pay, just go right ahead and pay, but just don't break the liquidity levels that are statutory? Is that the response that we should have seen?
Maybe yes, because if you have something set in stone and it's there in statute, that you're required to maintain certain ratios for your capital reserves, then yeah, that's why I said, that's the possible overreach.
Yes.
There may be certain banks that are prone to more economic shock than others. The smaller banks, the tier 3, tier 2 banks in our country, could possibly be prone to bigger shocks compared to a tier 1 bank like KCB or Absa. And that's where I say CBK could be possibly overreacting and overreaching its mandate. But, strong liquidity on its own does not justify a bank regulator trying to step in to ensure that banks don't go under. If we look at how the COVID-19 situation has panned out, this third wave is looking like the worst we've experienced so far since last year, March, April.
Yes.
And if that does happen, and if we do go back to a possible lockdown to reduce the number, not lockdown per se, but our measures that government had taken last year to try and reduce the numbers, the COVID positive numbers, then we will get into a situation where businesses are affected, banks are affected, and you could easily find yourself seeing tier 2, tier 3 banks really in distressed situations, which could lead them to going under. And when a bank goes under, remember, it's not only the bank that goes under, but it goes with money of depositors,
yes,
who are local Kenyans, and at the end of the day, it is the common man that goes ahead and suffers, not the bank itself. So when CBK is stepping in to ensure, or at least trying to plan ahead to ensure that this doesn't happen, it may be a good thing, but at the same time, it should be maybe it should have been rolled out on a case-by-case basis for each bank. Yes.
Ken, let me bring you in, and I want you to look at this quote for the Chief Financial Officer for Absa, who says, and I quote, "The directors did not recommend a dividend payout because COVID-19 is still here with us, and we're expecting a big third wave. until vaccinations have been done, we are still skeptical to say we are already on recovery. End quote. Ken, when you look at that quote, it's just pegged on COVID-19. The CBK is also just pegging that on COVID-19. Are we being a bit too critical on the CBK? Because, well, that's the same reason that Absa is giving out when they're cancelling the dividend payout. Because indeed, if some banks go right ahead and pay and we run into the deeper effects of the coronavirus pandemic third wave, we'll be crying to the CBK again as why we didn't foresee this. Can we give it that space and say, well, they're doing good? Because we also don't know when we're going to get out of the effects of the coronavirus pandemic.
Well, you make a very good point, Simba, and indeed, Absa, they have to be cautious because COVID has ravaged them, not least with the loss of the deputy CEO, which was very unfortunate. So it is, Siddharth had said that it is a big threat to economic growth, economic stability, and banks always have to be alive to the risk of anything that will affect the business. If the CBK was using that as sort of like a proxy for the bigger narrative, then it's true to say that COVID indeed has affected the economy, and until we get a long-term solution to this, it might be a problem. But what I was trying to raise was the fact that, you know, the fight against COVID had been about lives and livelihoods, and the Ministry of Health had really been very at the forefront of advocating vaccines and really making those vaccines accessible. But I think people are expecting now from the Treasury and the central bank side for them to look at also livelihoods, to remember that businesses need liquidity, interest rates need to be lowered. And those are not the considerations that our CBK have. In fact, you'd think now the CBK has become the Ministry of Health. So it's important that everybody focuses on their mandate, allow the Ministry of Health to be able to push the vaccine program, but allow central banks. You know, when you look at the Fed, you know, for them it's really stimulus after stimulus after stimulus. You know, because they know that is their mandate, pushing liquidity, supporting systems, thinking through the fallow programs. But we don't see that kind of deep thinking here in Kenya. And for me, that is very unfortunate because Kenya is considered to be sort of the biggest economy in the region, and other countries will look at it. So I think it's been extremely disappointing from CBK in terms of really not being able to really unpack what monetary policy can do for Kenyans. I think it's a lost opportunity, and I think we'll come back again in a few years down to really look at, you know, why did we do so little to prop up the economy? Pretty
much. On that note, I'd like to beg that we end our discussion there in the morning. And thank you very much to Ken Gichinga, Chief Economist, Metropol Economics, and Said Shah, as a lawyer and economic analyst here with us at Metropol Television's Business AM. Good morning. That's all we have for you this morning.